You move the stop farther away because taking the loss now would put this week's bills back in your mind. The setup has already changed, but your financial need has not. So instead of responding to the market, you start negotiating with it. That is where the real problem begins. The question is not simply whether trading can produce enough money to cover expenses. The more dangerous question is what happens to your decisions when the market is expected to produce that money on schedule. A fixed obligation can quietly turn patience into urgency. Urgency leads to entering early, chasing price, adding when you should be reducing risk, or refusing to exit after the original idea is invalidated. And the counterintuitive part is this: needing consistent income can make consistent execution harder. Imagine a hypothetical trade. Price breaks above yesterday's high, pulls back, and gives you what looks like a clean continuation setup. You enter. Minutes later, price falls back beneath the level that justified the trade. Under normal conditions, you might accept the invalidation. But if you are already calculating rent, utilities, or next month's withdrawal, a small loss no longer feels small. Now the trade is carrying two risks: market risk and personal financial pressure. Those risks do not behave independently. One can change how you manage the other. The next chart makes that visible: the same setup, the same entry, and two different decisions at the exact moment the trade stops behaving as expected. You plan to exit if price closed back below the level that justified the trade. Then it happens. The level fails, the position turns red, and suddenly the stop feels negotiable. Not because the chart improved. Because this loss now means something outside the chart. Maybe that money was already assigned to rent. Maybe you were counting on this week to cover a payment. The moment a trade becomes responsible for a specific obligation, your relationship with risk changes. A normal loss no longer feels like part of an uncertain process. It feels like a financial problem you must prevent. That pressure can distort a simple decision. You move the stop slightly lower because the market might recover. Price falls again. Now exiting means accepting a larger loss, so you give it more room. The original trade is gone, but the obligation remains, and that obligation keeps you involved. Notice the sequence. Financial need creates resistance to losing. Resistance delays the exit. The delayed exit increases the loss. The larger loss then creates even more pressure on the next decision. So ask yourself something precise. If this exact trade had no connection to this month's expenses, would you still be managing it the same way? That question matters because the market cannot know when your bills are due. It does not adjust its probabilities to your calendar. And even if you could remove that pressure from every individual trade, another problem would remain: whether the account itself is capable of carrying the financial demand you are placing on it. A trader can be consistently competent and still ask too much from the capital in front of him. Suppose, hypothetically, you have a 20,000 account and you expect it to produce enough each month to cover a level of expenses that requires unusually aggressive returns. The problem is not necessarily your strategy. The problem may be the demand placed on the account. That distinction matters. When required income is too large relative to available capital, something has to give. Either the income falls short or the risk rises. And once risk rises simply to make the numbers work, position size is no longer being chosen from the trade itself. It is being chosen from the amount of money you want the account to produce. This is how a sound method can become dangerous without changing a single entry rule. You may see a perfectly ordinary setup, but instead of asking how much capital should reasonably be exposed, you begin asking how large the position must be to make the trade worthwhile. The chart has not become clearer. Your financial target has simply made normal risk feel inadequate. So separate two questions that are often confused: can your method make money over time? And can this amount of capital support the income you expect without forcing abnormal risk? Those are not the same test. And even when the capital appears sufficient on paper, the next difficulty is that market returns rarely arrive in the neat monthly pattern your expenses expect. A good month can make trading income look predictable. 3 profitable weeks arrive close together. The numbers appear orderly, and it becomes easy to assume the next month should behave the same way. But markets do not distribute opportunity according to a calendar. You can execute the same process with the same discipline and still receive very different outcomes from one month to the next. One period may contain several clean moves. Another may produce smaller ranges, failed follow-through, and fewer situations worth acting on. The quality of your decisions can remain stable while the money produced by those decisions changes sharply. That creates an important distinction. Consistency in behavior does not guarantee consistency in monthly income. Suppose, hypothetically, your trading produces a strong January, a modest February, and almost nothing in March. Looking only at the 3 months together, the process may be functioning normally. But if you judge each month as an isolated paycheck, March appears to be a failure. That expectation can corrupt how performance is measured. You stop asking whether decisions were sound and begin asking whether the calendar received its required number. So examine your own assumptions. When you say trading should pay you monthly, are you describing something the market actually provides, or something your personal finances would prefer it to provide? And when a profitable period finally does arrive, another decision becomes unavoidable. How much of that money can leave the account without changing the trading operation you return to? A profitable account can look healthy right up to the moment too much of its strength is removed. Suppose, hypothetically, you begin with 50 zarozen, build the account higher, and then withdraw a large portion of the gains for living expenses. The withdrawal may feel harmless because you are taking out money you already earned. But the next trade is not being placed from the old account. It is being placed from the smaller one that remains. That changes the operating base. With less capital, the same dollar risk now represents a larger percentage of the account. If you reduce position size to keep risk proportional, future gains will also be smaller in dollar terms. If you refuse to reduce size, you quietly increase the strain placed on the remaining capital. The withdrawal itself is not the mistake. The danger is treating removed capital as though it still exists. This is why the useful question is not simply, how much profit did I make? It is, what condition is the trading account left in after I take money out? Imagine earning 8,000 and withdrawing 7,000. On paper you had a strong period. Operationally, however, you preserved very little additional cushion for what comes next. And that creates a subtle pressure. Once money leaves regularly, the account may begin to feel as though it must continually replace what has been removed. The next problem begins when that need for fresh profits starts influencing which opportunities you are willing to accept. You can usually tell when selectivity is beginning to weaken because trades start appearing where, a week earlier, you would have seen nothing worth doing. Suppose, hypothetically, price has already made a strong move before you arrive. It pauses near the highs, but the entry is late. The structure is crowded, and the distance to a sensible exit is poor. On a normal day you pass. But after several quiet sessions, that same chart begins to look acceptable. Nothing improved in the setup. Your need for action changed the standard. This is one of the quieter dangers of depending on trading income. When doing nothing produces nothing, inactivity can begin to feel expensive. Then the mind starts searching for reasons to participate. A weak pullback becomes good enough. A breakout with poor location becomes worth a try. Uncertainty has not decreased, but your threshold for accepting it has. That matters because trade quality is often lost before the order is ever placed. A useful test is to compare your behavior across different conditions. Would you take this exact setup after a strong week when you feel no urgency to produce? Or does it only become attractive when the day has been quiet and the account has not moved? The market offers opportunities on its own schedule. The moment you begin manufacturing them, you are no longer selecting from what is present, and once lower, quality trades begin producing losses. An entirely different pressure starts to build around what you believe must be recovered. A drawdown becomes more dangerous when you stop seeing it as a change in account equity and start seeing it as money that must be won back. Suppose, hypothetically, you are down 4,000 from your recent peak. The next setup appears, and instead of judging it on its own merits, Part of your mind is already measuring how much of that 4,000 this trade could recover. That changes the purpose of the position. The trade is no longer simply an opportunity with uncertain odds. It becomes a repayment attempt. Because the goal is now recovery, normal profits can feel too small and normal risk can feel too slow. That can push you toward larger size, longer holding, or a willingness to press harder than the setup deserves. The market does not know your previous high watermark. It does not offer better odds because you are below it. The practical danger is that every new trade begins carrying the emotional weight of the trades that came before. One loss becomes two problems, the loss itself and the growing urgency to erase it. That urgency can distort the next decision before price has done anything wrong. So ask yourself, if your account had never reached that previous peak, would you still be taking this trade with the same size and expectations? If the answer changes, you are no longer responding only to the present setup, and once recovery pressure persists long enough, the next temptation is often to question the method itself before you have enough evidence to judge it. A strategy can look broken simply because you are watching it during the wrong stretch of outcomes. Suppose, hypothetically, you have followed the same method for months. The logic has not changed. The setups still appear, but over the last 3 weeks, several clean-looking trades fail and the results flatten out. Now a new system begins to look attractive, especially one that seems to be working in the market you are currently seeing. The danger is not in reviewing a method. The danger is changing it before you know what the recent results actually mean. Every trading approach has conditions it handles well and conditions it handles poorly. A short unfavorable period may be normal variation, or it may be evidence that something has changed. Those two situations require very different responses, yet impatience makes them feel identical. If you abandon the method too early, you also abandon the evidence you were collecting. Then the new method starts with a fresh sample, and the judgment process resets again. After enough switching, you may have plenty of trades but very little usable information. So the important question is not, has this strategy disappointed me recently? It is, what evidence would have to exist before I could reasonably say the method is no longer behaving as expected? Without that standard, frustration becomes the decision maker, and if the method does begin producing strong results again, another risk appears quietly, allowing temporary success to create permanent financial obligations. A strong run of profits can change your life faster than it changes the market. Suppose, hypothetically, 6 good months lead you to upgrade the car, move into a more expensive apartment, or take on recurring costs that once seemed unnecessary. Nothing about those choices feels reckless while the profits are arriving. The danger appears when temporary trading results are converted into permanent monthly obligations. The market has not agreed to support the new lifestyle. Once expenses rise, your required performance rises with them. A month that would once have felt acceptable can suddenly feel inadequate, not because your trading deteriorated, but because your personal cost structure changed. Success has quietly raised the minimum result you believe you need. That creates a different kind of pressure from simply wanting more money. You are no longer chasing an improvement. You are defending a standard of living that now depends on continued market performance. So look at your expenses the same way you would examine a position. Which costs are flexible and which continue regardless of what the market gives you next month? The important distinction is between enjoying a profitable period and building obligations that assume the profitable period will continue. Because once lifestyle becomes evidence that trading is working, reducing those expenses can begin to feel like something more than a financial decision. It can start to feel like admitting that the trader you believed you had become may not be as secure as you thought. There is a point where trading stops being something you do and starts becoming something you feel required to prove. Suppose, hypothetically, you have spent years telling yourself that living from the market is evidence that you finally made it. Then performance weakens, and taking outside income becomes a reasonable option. But instead of seeing that choice as practical, you see it as retreat. That is when identity begins interfering with judgment. If stepping back feels like failure, you may remain active simply to preserve the image of being a full-time trader. You may reject useful alternatives, refuse to reduce exposure, or keep forcing participation because inactivity threatens the story you have built about yourself. The market has no interest in that story. It does not reward commitment because you have sacrificed time, status, or pride, and it does not punish you for changing course. Those meanings exist only in your mind, but they can still shape real financial decisions. So ask yourself a difficult question: if nobody knew how you earned your income, would you make the same choices about how much trading should control your life? If the answer changes, reputation may be carrying more weight than economics. And that leads to the final structural question. Before deciding whether trading can pay all your bills, you first have to decide which bills trading should be responsible for in the first place. The question becomes clearer when you stop treating trading income as either everything or nothing. Suppose, hypothetically, your household has several layers of expense. Housing, food, insurance, and basic commitments cannot be postponed. Travel, upgrades, and optional purchases can. If trading is responsible for every layer, then every dollar of personal life is tied to an uncertain source. If it is responsible for only part of that structure, the relationship changes. The important point is not comfort, it is dependency. Two traders can use the same method, take the same trades, and produce similar results, yet operate under very different financial arrangements. One may require trading to support every essential obligation. The other may have those obligations supported elsewhere and allow trading income to serve a narrower purpose. Those are not merely different lifestyles, they are different operating structures. So instead of asking only, "Can trading pay my bills?" ask a more precise question: which obligations am I deliberately making dependent on trading? That forces you to separate what trading can potentially produce from what you are requiring it to provide. The answer may not be permanent. Your structure can change as circumstances change. But unless the responsibility of the trading account is defined clearly, you cannot judge whether the arrangement itself is sound. And that leaves one final decision to examine: what exactly would have to be true before you could responsibly make trading income essential rather than optional?